Hello, welcome to the Grow Your Wealthy Mindset podcast, where it is all about helping amazing physicians just like you create a wealthy life free from burnout and with the financial security to practice medicine on your own terms. I'm your host, Dr. Elisa Chiang. Hello, and welcome back to the Grow Your Wealthy Mindset podcast. The Leverage and Grow Summit wrapped up last weekend. This year, I wasn't able to attend as much of it as I usually do or have in the past, due to other evening commitments, and I was working during the day, as well as travel delays on Friday. I did spend a lot of time at the socials and coaching people over the weekend. If you missed it this year, I would really make sure that you attend next year. I talked to lots of people during the socials who attended for the first time, and they were simply blown away. And they really absolutely loved the summit. It's totally free to register, and it's only $79 for the VIP All Access Pass, which gets you to the Q&As with the speakers, as well as get recordings so that you can watch it later on. If you just do the free option, the recordings are available for 48 hours. Since the summit is typically 5 days, it usually runs from Wednesday through Sunday, I think it's worthwhile to get the recordings. I actually bought the VIP Access Pass before the very first Leverage and Growth Summit back in 2020. Knowing that I probably wouldn't watch all the recordings, and for $79, it was the easy choice to do that. Let's get to the actual topic of discussion for today's podcast. By now, if you listen to the news, or at least any financial news, you've probably heard about the collapse of Silicon Valley Bank, also called SVB. Silicon Valley Bank is a specialized bank that provides financial services to technology and innovation-focused companies and investors. It's the 16th largest bank in the United States, with over $136 billion in assets as of 2020. In recent years, the bank has faced several challenges related to its risk management and compliance functions, including regulatory lapses and exposure to risky lending practices. On Monday, March 8, 2023, Silicon Valley Bank reported losing $1.8 billion on their bond portfolio, as well as their intention to sell both common and preferred stock to raise another $2.25 billion. After that announcement, Moody's downgraded SVB's long-term local currency bank deposit and issuer ratings. So then what happened was that on Thursday, March 9th, the stock of Silicon Valley Bank's holding company, SVP Financial Group, crashed when the stock market opened. High-profile venture capital firms urged their portfolio companies to get their money out, and the bank saw attempted withdrawals of $42 billion before they closed early on Thursday. So this is what happens when there's a bank run on money, and it really led to the second biggest bank failure in U.S. history, the largest being the collapse of Washington Mutual in 2008. So with all this happening, it's raised a possibility of widespread layoffs of startups and broader instability in the U.S. financial system. On Friday, March 10th, federal regulators announced that they would take over the bank before the bank opened for the day. Trading was halted for SVB financial stock. The FTC also promised that insured deposits would be available by Monday, March 13th, for withdrawal. On Sunday, March 12th, federal regulators announced that they would actually invoke a systemic risk exception, meaning that all depositors would be made whole, even for those funds beyond the $250,000 protected by FDIC insurance. Up to that point, companies spent the prior 3 days anxiously waiting to find out whether and when they'd be able to retrieve their funds in excess of the $250,000 limit guaranteed by the FDIC. Only 12.5% of SVB's $173.1 billion in deposits were actually insured at the end of 2022, according to the bank's annual report. To give you an idea of the kind of deposits that were held at SVB, according to the Los Angeles Times, quote, one tech founder based in Los Angeles said he wasted no time in moving money out of SVB as soon as he heard about the stock drop and was able to recover 85% of his company's funds, though his company still has several $1 million left in SVB, end quote. If consumers had not attempted to withdraw all their deposits at once, many observers believe that SVB probably would have been able to weather its liquidity crisis. A new study found that 186 more banks are at risk for failure, even if half of their depositors decide to withdraw their funds all at once. Banks take deposits And then they make money by making loans with those deposits at a higher interest rate than they pay on those deposits. Those loans may be on home mortgages, car loans, business loans, or even loans to the U.S. government in the form of bonds. SVB held most of its asset in U.S. government bonds, which seems like a safe choice. Treasury bonds tend to have relatively low returns and relatively low risk. After all, the federal government can always print more money to make sure that they are able to pay off their loans. However, the market value of bonds went down as the interest rates started going up, and the interest rates have risen fairly quickly recently. When interest rates rise, the lower fixed interest rate paid by a bond is no longer as attractive to investors. If the bond is held to maturity, then the holder of the bond does get paid the original interest rate along with the principal, so there's not actually any loss of money. However, if you need cash, so you have to sell your bonds on the bond market before maturity, then they can be worth less, meaning that you sell them for less than the original principal amount on the bond. For example, let's say you have a 10-year bond of $100,000 that's paying 2% interest rate, and we're just going to calculate using simple annual interest. So after 10 years, you would get $20,000 of interest paid to you as well as $100,000 of principal for a total of $120,000. If interest rates rise to 5% after you've held this bond for 5 years, then someone buying a new 5-year bond at $100,000 at 5% would get $25,000 of interest in 5 years plus their principal of $100,000. From someone to buy your bond from you, they would only buy it for $95,000 so that they still get $25,000 in interest payments after 5 years, which means that you're losing all your interest as well as $5,000 of principal. Now, those numbers aren't perfectly correlated to exactly the same interest rates, but I'm just choosing numbers that are close so you understand the concept. For SVB, the timing of interest rates going up and their value of their bonds decreasing unfortunately coincided with financial difficulties of many of the bank's customers, largely tech startups, which caused those customers to withdraw their funds. SVB was forced to sell securities out of their bond portfolio and lock in their losses in order to have enough cash to actually give to their customers who were making withdrawals out of their accounts. So that's why they had to sell their bonds at a loss, as well as sell off more stock in order to raise more capital. Another finding is the revelation that in 2020, SVB had failed to file suspicious activity reports for several years, despite detecting potentially illicit transactions by its clients. Suspicious activity reports are mandatory reports that banks must file with the Financial Crimes Enforcement Network of the U.S. Department of Treasury when they suspect or have reason to suspect that a transaction involves funds from illegal activities or is intended to hide such funds. The failure to file those suspicious activity reports is a serious breach of the anti-money laundering regulations, so that can result in significant fines and legal penalties. The U.S. Department of Justice and the Financial Crimes Enforcement Network are reportedly investigating SVB's compliance and whether it adequately addressed the issues after discovering them internally. SVB's lending practices have also come under scrutiny, particularly its exposure to the troubled fintech leader, Greensill Capital. SVB reportedly lent hundreds of millions of dollars to Greensill and its affiliates, which ultimately collapsed in early 2021, leaving SVB and other lenders with significant losses. The incident has raised questions about the due diligence and the risk management practices of the bank and the broader banking industry's exposure to risky loans. As of 2020, SVB's loan-to-deposit ratio was 93.1%, according to the bank's financial statements. This means that for every $100 in deposits, the bank has lent out $93.10 to its borrowers. The average loan-to-deposit ratio for banks really varies depending on the size and type of institution, as well as the economic conditions and other factors. According to data from the Federal Reserve, the average loan-to-deposit ratio for all U.S. banks was 73.9% as of September 2021. However, this figure can vary widely depending on the type of bank. Loan-to-deposit ratios can vary widely depending on the bank's business model, lending practices, and market conditions. Large banks typically have lower loan-to-deposit ratios due to their ability to access other sources of funding, while smaller community banks tend to have higher ratios due to their focus on local lending. A bank that specializes in high-risk lending may have a higher ratio than a bank that focuses on traditional lending products. SVP's strategy of loaning money to tech startup companies seems to me to be relatively high-risk lending. As of the date I'm recording this podcast, which is March 20th, 2023, there have been no reports of SVB being sold to another bank. On March 17th, SVB Financial filed for bankruptcy. Despite facing regulatory and lending issues, SVB does remain an independent institution and continues to operate as a specialized bank focusing on serving the technology innovation sector. While depositors won't lose money, shareholders of SVB Financial Group and unsecured debt holders are likely to take a loss. So what's happened at SVB raises broader concerns about the effectiveness of the U.S. banking system's regulatory framework. The regulatory framework is what governs bank activities and safeguards the interest of their clients, as well as the wider financial system. There was a lot of scrutiny after the 2008 financial crisis, and a lot of new regulations did go in place at that time. However, some of those regulations are starting to be chipped away at so that we do have less regulations. Federal regulators decided to fully insure all of SVB's depositors to prevent the impact of the bank's collapse that could have on the economy as a whole. While SVB Financial Group stock plummeted, when SVB's financial stock price plummeted last Thursday, other banks also saw their stock prices drop. And the government doesn't want people to lose confidence in the banking system. The government also announced the creation of the Bank Term Funding Program, BTFP, which authorizes the Federal Reserve to offer loans to banks, credit unions, and other deposit unions for up to 1 year in order for the financial institutions to have cash for their depositors to withdraw without having to quickly sell their assets in order to get it. The U.S. banking system still remains one of the most stable and well-regulated in the world. My recommendation is to limit your deposits to $250,000 per type of account per person in an FDIC-insured bank. Type of account means that you could hold $250,000 in your checking account and another $250,000 in your savings account, since deposits held in different ownership categories are separately insured, even if they're held at the same bank. FDIC insurance is also per person, so each co-owner of a joint account is insured up to $250,000 for a combined amount of each person's interest in the account. The FDIC assumes each co-owner to be an equal account holder unless the bank records clearly indicate otherwise. To wrap up and summarize, what happened at SVB highlights the importance of a strong risk management and compliance functions in the banking industry. It also shows how important it is that depositors feel that their deposits at the bank are safe so that we don't have runs on banks. Right now, depositors can be confident of the safety of their deposits up to $250,000. This has brought up broader concerns about the effectiveness of the U.S. banking system's regulatory framework, which means we really need more oversight. I personally am not taking my money out of the bank, but I've actually always made sure that there was less than $250,000 in each account. So I hope that explained for you what happened with SVB. The collapse of SVB isn't something that is affecting me personally, and I think it's probably not so likely to affect the listeners of this podcast personally, though who knows? You may have a spouse or family member who is in the tech industry in California and it is affecting them. I think it's too soon to tell what the long-term effects of this event will be. I do know that in the last week, I've gotten different emails, texts, and even people putting on webinars to discuss more about the SVB situation. For now, I recommend keeping steady with the financial plan that you've currently built for yourself. And if you haven't built a financial plan for yourself, I really encourage you to do so. If that's something you would like help on, I'd love to be that person to help you. I am not a certified financial planner, but I do help my clients achieve financial freedom. We do this by having you control your money so that you can make your money work for you, so that you don't have to keep working for money. If you're interested in working with me, go to my website, growyourwealthymindset.com, and set up a discovery call. I'd love to talk to you. As always, thanks for listening to the Grow Your Wealthy Mindset podcast. Be back next week. If you enjoyed this episode, I would love it if you could share it with your friends and colleagues. And now for the disclaimer. I am not a certified financial planner, accountant, or attorney, and nothing I say should be construed as professional investment, tax, or legal advice. This show is primarily for your education and entertainment. I am a physician, but I'm probably not your physician. So if you need any medical advice, please contact your own physician. Thank you.